Nalu FM Finance Podcast. Insight into the financial markets. But first, a word from our founding sponsor. Are you missing the sun? Always wanted to go to Hawaii? Go to halecapri.com.
I'm here at the Fortem Capital office in London with Toby Hayes, who is the fund manager for the Alternative Growth Fund, and we're here to talk about alternative beta today.
Hello.
Hi, Toby. What actually is alternative beta or quantitative investment strategies, factor investing, risk premia? All these words are floating around and nobody really knows exactly what is what.
I don't think it's my position to define all of them simply because everybody has a different version of what each individual strategy means. However, there's a broad theme that encompasses all of them, and what it is that these are all describing return sources that are embedded in traditional asset classes, and they have always been there. They are not new. What is new is that there are now various techniques to isolate and access those return sources on their own, where before you would have to have bought the asset class and all the residual risks that came with it. And the various terminologies that describe it are really just focusing on this issue that there are now embedded sources of return that you can access separately and then put in a portfolio separately.
And how do these alternative beta strategies work? How do they create the value? How do they extract the return?
Each strategy is different in its own right, but I think there's maybe three broad camps of styles of return, shall we say. The first off, I'd say, is what I would call structural factors or structural risk premia, structural alternative beta, to take your pick. These are return sources where the return is due to some structural phenomenon in the market, some regulatory aspect or some flow aspect where it is the return source is in many ways independent of macroeconomics, independent of cyclicality, and due to the very nature of the market itself. The second source, I'd say, what I describe as behavioral. These are return sources that play on investor psychology, psychosis, take your pick. A good example of this would be momentum strategies. Momentum strategies, there is no real fundamental reason why they should work. They really just play on the fact that investors chase past returns, and there are many similar behavioural strategies available, but they would sit in that bucket. And the final one I'd broadly class as insurance-style strategies. These are strategies where you are paid a coupon, a premium to bear some sort of market risk. So, and examples of this would be selling volatility or carry strategies. These are clearly these are clearly correlated with broad market equity beta, or behavioural strategies can be correlated or can be negatively correlated, and structural strategies tend to be completely independent because their return source is really due to the idiosyncrasies of each individual market and the structural phenomenon therein.
And when you identify such a strategy, how do you evaluate the strategy that it's the right investments? How do you compare them with each other? Do you ratios, Sharpe, or?
There's one of the characteristics of risk premium generally is that they tend to have a return profile that is different from equities and bond returns, and for that matter, tend to be more normally distributed. And they're not perfectly normally distributed, but tend to be more normally distributed. Risk premium or alternative beta tend to have more fatter tails distribution. What that means is they can have very steady returns and sometimes quite sharp losses that are disproportionate relative to the steadiness of the daily return. So when you're analysing them, typical metrics that use normality as their assumption, so I'm talking about standard deviation in particular, are not really appropriate. So you need to really look at risk metrics that adjust for fat tails, and in particular VAR is the obvious one, and there's various tweaks on the VAR statistic which called modified VAR, which takes account of the non-normal distribution, and I find that these adjusted statistics that actually account for the fat tails are much more accurate in assessing the risk of these risk premia.
Now, many of these strategies, obviously, when they get developed by the providers, feel sometimes they're optimized for backtesting. How do you make sure that you don't invest in a strategy that's very sensitive to the backtesting assumptions?
There's no surefire way of doing it. The obvious one is to only invest in strategies that have got a significant track record. The other sort of telltale technique, I suppose, is to keep it simple. These strategies and factors are not new strategies. They've been written about in academia for nigh on 80 years or so. And so when you're assessing a strategy, you've really got to see, is it really accessing the factor itself, or is it does it have some newfangled technique to extract value? If there's complication, if there's convenient switches and threshold values which allow it to get in and out of exposures, these are all telltale warning signs. And it's not that the more dynamic allocation methods can't work. It's just that if you are looking at a strategy that has a more dynamic allocation process, it really needs to have a long track record to justify its investment. So in that regards, if you stick to very simple, pure, clean strategies, you are halfway there to separating the wheat from the chaff.
You mentioned one was the track record and how long it has been in place. But if it has been in place for a while and successful, is there not the risk of crowding and then reducing the opportunity?
It again depends on the strategy. There are some strategies that are very prone to crowding and basically being arbitraged away, where some are actually the quantity of flows that go into them from the quantitative investment strategy universe is tiny compared to the flows in the actual market. And I use the commodity example the best. Most commodity flows are due to real-world producers and hedgers looking at various aspects of commodity markets. The flows that come from the risk premium world are tiny in reference to the real world flows. And so the shapes of curves that give you the return source are due to the real world participants. So it's very hard for, as I say, large flows in the risk premium world to distort that return source, because, as I say, the return source is there to actually more due to structural reasons. But again, there are on the opposite side of the fence, there are plenty of risk premium strategies that do get crowded and can actually get so expensive that can adopt a completely different return profile than you would expect due to the crowding. So it really depends on the risk premium question and an understanding of what the risk premium is doing and the understanding of the underlying markets as well.
Now, all your knowledge and expertise obviously is going into the managing of the Fortum Alternative Growth Fund. Could you a little bit explain, what the aim is to achieve with the fund, and how you manage the different exposures, the different factors, and how maybe your macro view also plays into it?
Well, this is a very strange alternative product in the sense that we've deliberately avoided macro. I've been a macro manager for the last 20 years, and I've chosen a product or designed a product that is deliberately trying to avoid all sources of return that are driven by macroeconomic cyclicality, and in particular what the Fed does. The reason being is we want to have an alternatives fund that is truly uncorrelated from the main asset classes, equities and bonds. From most people's perspective, your alternatives bucket it shouldn't be correlated. It's really there to provide diversification. And in a world where both bonds and equity prices have been bid up by excess liquidity from central banks, most alternative sources of return in the risk premium space, as well as in traditional alternative space, such as property and real estate, etc., are becoming increasingly correlated, and the function of the alternatives bucket general is becoming increasingly downgraded. So the real rationale for the fund was to only focus on the risk premium strategies that are structural in nature, and their return source and their risk is independent of macroeconomics and cyclicality. So for this fund, we've obviously there is behavioural and insurance-based risk premium. We're just focusing on the structural risk premium because they are not only statistically uncorrelated but fundamentally unlinked to macro. So therefore, we can hopefully fulfill our duty in delivering uncorrelated alternative returns.
And what is the reasonable expectation to have on the return profile for the Fortum Alternative Growth Fund?
In terms of risk and return, we're targeting 4 to 5% per annum. In terms of returns, the risk on the fund will be probably in the region of 3 to 4% volatility. And I mentioned volatility because that, in terms of standard deviation, because that's what everybody uses. But obviously, the fund is actually managed to a vast statistic. But broadly speaking, we're targeting 4 to 5% returns.
And who is the strategy suitable for? Who is a target investor, and what time horizon should they have?
Yeah, it's a UCITS fund, so we have daily liquidity. We have very reasonable pricing. Our initial target market is the UK DFM market, but because it's specifically designed to fit in within a traditional multi-asset portfolio, we think it makes perfect sense for various multi-managers and fund of funds. It's currently not being targeted to retail, but that potentially may change in the future. But for the moment, it's not. So, but it's really we see this as a perfect filler for an alternatives bucket within any traditional multi-asset environment.
And when you actually manage the fund, can you walk us a little bit through your portfolio construction investment processes? Is that it's very regular reviewing? How active is?
Well, I think there's two parts of the fund. There's what I would say is the core portfolio, which is a selection of, as I say, these structural risk premia. These are return sources that are independent of macro, independent of the Fed, and they're also totally uncorrelated with each other. There are not, if you think about it conceptually, there's not very many strategies that have no link to macroeconomics and yet are financial strategies. It's sort of an oxymoron. So and if you look at the structural risk premium universe, it is relatively small, but one of the nice things about the structural universe is that they tend to be one of the more consistent return strategies. So that would make the core of the portfolio. We've left ourselves a little space in the portfolio for what we call opportunistic structural trades. These are when you have, and especially in derivative world, there is plenty of large flows into various structured products of various different types, and these cause distortions in various different curves. This gives the fund an opportunity on a broadly tactical basis to take exposure in while still maintaining zero correlation with equities, etc., but allows to access a structural return that is temporal in nature. So this happens quite a lot within structured product land, and there's various factors that get distorted, and that gives us that part of the portfolio will take up disproportionately more time as time goes by.
Mm-hmm. You probably answered partly already my next question, actually. What makes the Fortum Alternative Growth Fund unique to other funds that claim to do alternative betas?
There's plenty of factor funds around. There's far too many, and it's probably led to a bit of a crowded space. But if you look at all the factor-based portfolios, nearly all of them, I would say, are in the equity factor space, which are long-short equity factors. And then you have, and then the second sort of type of equity factor fund, then most of these guys are in carry and volatility strategies. Now, if you know carry and volatility strategies, carry and volatility is highly correlated with equities. Actually has quite good Sharpe ratios, and there's nothing wrong with it as a risk premium as per se. But if you want to build a fund that is uncorrelated with equities, it is not a particularly great idea to put carry and vol in the fund. So we as a fund house are deliberately avoiding that aspect. If you look at the equity factor land as well, I believe that the equity factors are, well, one, they're highly cyclical in nature and they tend to behave differently depending on where you are in the cycle. But they're also fundamentally, I think they've been distorted by Fed liquidity to such an extent. I think allocating between equity factors is now nigh on impossible. Such like I believe that asset allocation is becoming harder and harder and harder because you now have to second guess what the Fed's doing. So most of the risk premia universe sits within those two camps, the equity factor land or the carry and vol land. We have deliberately avoided both those sections and just investing in what I would say structural risk premia. And this is the only fund I know of, and my goodness, we've looked for it, but what I would say is that the return sources are purely structural. There are funds, multi-asset funds out there that have small allocations to structural risk premia, but this is the only fund I'm aware of that is purely based on structural returns.
Fantastic. Thank you, Toby, for your insight and time.
Thank you very much.
Are you missing the sun? Always wanted to go to Hawaii? Go to hallecapri.com. Nalu FM Finance Podcast.